welcome to Analyzing Finance with Nick. This video is going to be a release of a recording of a research expert call that I do with my clients. It's kind of an example of the type of content you would get from Davos Platinum Research. It's what I do for my institutional people, and as a holiday gift to my subscribers, I'm going to release this one onto YouTube. It's with my friend and technical analysis expert Tony Greer from TG Macro, talking about a lot of the technical analysis trends in the marketplace. Just as a disclosure, it's intended for an institutional audience who makes their own research decisions, so please do your own due diligence or find a financial advisor before making any trades. And nothing in there is specific investment advice. In addition to that, if you like the content that we are providing for you on this channel, feel free to like or subscribe to the show and watch through the whole videos. Those are the three things that help grow this channel and allow me to produce more and better quality content for all of you. And with that, now on with the actual show. Hello everybody, and welcome to our monthly Davos Platinum Research Expert Call. I'm bringing back Tony Greer, our resident technical analysis expert, who's a good friend of mine who runs TG Macro. And I would like to have him go in and talk about a lot of things going on today. We have a weird market where you're getting a lot of bullish breakouts, but that are far detached from really any sort of like traditional fundamental price target. So it's a tricky time to trade it. There's money to be made at this point of the cycle, but the risk management I think has to be constructed a little differently. The first question I really have is, when does the inflation narrative transform from being good for markets to bad for markets?
Great question, Nick. During this, bizarre period of, inflation and the supply chain issue and rising prices right before our eyes, and finally headline inflation kicking in, so it's like, when does that become a problem for the economy? And I'm going to say that because a lot of it is being caused by, ESG and the pivot to carbon neutral, I'm going to say that some of the failures there are more likely to cause the pendulum to swing back than prices even this time. I mean, they're going to kind of be one and the same, but, if it's not $7 gas, that makes it, visibly unpopular for people to drive, et cetera, and, really more difficult for the middle class to just fill up and get on the road. I think that's the traditional way to look at it, but given the current situation, I think that going without heat for a long period of time, freezing will be the first level of pushback, and I think we're approaching that situation in the UK with their natural gas supplies dwindling and a lot of their power generation still trying to pivot into wind and solar, but knowing that the fallback is into natural gas. But because they've, attacked the production so well, there's not as much natural gas and not as much drilling and not as much incentive to do so. So in my opinion, it's not exactly going to be the same as the other times where it's just, okay, commodity prices are too high, right? Traditionally, Nick, it's been the cure for high prices in commodities is high prices, right? And that's when everybody's able to turn all of their resources and pivot their resources into producing oil or more grain or something like that. And that's currently being disincentivized, right, by the administration and by a lot of things that they're doing. And I don't even want to get political, but their energy policy is a totally separate animal that affects our markets, right? And we're going through this push to carbon neutral in an extremely hasty fashion, and it doesn't seem like it's the smartest way. It seems like we're imposing this on ourselves, and Russia and China are not, and they're kind of stepping into the fossil fuel space to fill the void. It seems like China's going to be doing more drilling. Russia has got the pipeline to Europe that seems like a little bit of a political football now as well. And so I think that that's going to be the source of where the separation from inflation being good for the economy and getting prices running and it becoming a problem for the economy. That's my opinion on that. That's fair.
Yeah. Do you have any, like, we've run our alternative CPI data, and even the core is running about 2 times the government headline claims it to be, which is kind of concerning to me. But I think a lot of that drives also housing, which is up 18% almost year over year. And if without central banks hiking, what would be the catalyst for housing inflation to normalize?
No, I mean, that's a good question. I always look at it, I look at it as sort of the secular trend in housing as what's being the driver there. And then I look at sort of long end rates staying under control as being I guess one of the more positive flywheel, generators within the home builder story. Right. Just yesterday was a perfect example. Home Depot and Lowe's took off and left the building within the Homebuilder ETF. Right. And I consider them part of the home builder trade since they're, the retail part of home building is a crucial part. It fits into the secular bull market in housing, which is, to my opinion, a two-part story where, people are leaving cities, preferring a little more safety of the suburbs as a secular trend, and people working from home more. And so if they're working from home more, they tend to build out their office more and their home gym a little more. And all of that is sourced from, Home Depot and Lowe's at the retail level. And the home builders are sourcing their materials, from wholesale places at another level. And they're able to pass the costs off to the consumer because the consumer is more interested in getting the next place to live, and getting that built and up and running. And so I feel like that's why, this sector at least has been, for me, evidence-based investing, because, housing starts are beating, existing home sales are better, inventories are lower, prices are rising, their seller has the pricing power. To me, that's a pretty healthy bull market, and the home builders are just participating. And then you look at their earnings, and it's reading right through to their earnings. Where they're beating a dollar estimate with $1.25, and they're raising their year from $4 to $5.25. And you're like, okay, this is significant stuff here. These guys are really socking it away under these conditions. So that's why I do see certain breakouts winning, and that's kind of been my mantra in this bull market, is that breakouts win. And like this, the home builder sector just consolidated for 9 months and then broke out again. So to me, the timing of all this sort of baton handling in the equity markets from sector to sector with different types of leadership, and you'll have energy lead one day, and then you'll have tech lead the next day, and all of this taking place in sort of a rising rate, rising dollar environment. And, that seems to me like that would normally be a pretty decent headwind. And all it says to me is that if the dollar turns back down now, the commodities and stocks are just going to fly. So that's kind of the way that I'm fitting it together, if that's fair.
Yeah, I mean, the ITB, the Homebuilder ETF, just broke out this week. I mean, this is a classic example of this. I mean, how high do you think this could go, just based on chart analysis?
Well, I mean, if the market is a forward-looking indicator, and we just had home builders just beat earnings and guide higher, it's probably going to be another couple of quarters of driving these stocks to the next level. And I'm not a valuation guy, so this is a breakout that I can go along with. This checks a lot of boxes for me technically, checks a lot of boxes for me fundamentally. The industrial data that's been coming out and on the economic side has been, not terrible, slightly better. Industrial production, the stuff that leads itself to home builder strength, has been pretty strong. So, it's a breakout that I can definitely play. Sorry, I'm trying to get that alert to stop.
Yeah, speaking of, it's the broader theme of, you're seeing a lot of sectors, like there's a little bit of a correction, say, the last week or two. But in general, you've seen a lot of these sectors that have been stuck in these consolidations at a pretty high level of consolidation, breaking out, like small caps, mid caps, for example, home builders, which we already mentioned. Like, if you want to get upside exposure on that, and there really isn't a valuation target because they're already trading at historically high all-time forward and trailing PEs. How would you manage your risk on this to figure out what to get a good setup here? Like, I know maybe you put the stop down at the whole breakout, but how high does it need how high do you think you can go to this make sense? Or
Well, Nick, it's hard. It's hard to pick targets. It's hard to say how high it can go. I try to see. I look at, to me, maintaining my bullish posture in the equity market is looking over at the mechanism that I think is driving it to check and see if it's intact, right? Right, the Fed balance sheet, right? So every week I'm checking the Fed balance sheet, and every week it ticks higher. Without looking, how much have we added to the balance sheet this year? $1.7 trillion, right? And we're talking about tapering, and we're talking about, tapering at 15 billion a month less, or 20 billion a month less. It's like, that's not tapering. That's posturing, right? That's posturing as saying, okay, we're going to recognize this inflation. We're going to do a little something about it, but we're not changing course, and so I kind of feel like that as long as the market can bear that. I look at other sectors that are breaking out right now, Nick, some subsectors of tech, and it makes a lot of sense to me. I mean, cybersecurity, up and gone. Software, up and gone. Social media is struggling quite a bit behind these Facebook woes that it's been having in its transformation to Meta. I'm not smart enough to figure out what that's going to mean for the stock. I'm just observing. But some of the, the subsectors of tech, that's the sector that I had in mind that was going to pull back in a world of higher rates and in a world of inflation. Those deflationary stocks that had been leading the market so long, to me, were going to have to come under pressure because the whole world has been positioned for deflation, right? Portfolios positioned for deflation, from their positioning in the stock market to their ratio in stock versus bonds, right? They're staying long bonds. And you have to say, man, if we're going to see significant energy inflation and food inflation, and we've got this supply chain shortage, and, M2 is growing at an exponential pace compared to what it used to grow at, we are going to have some hard asset inflation. And so, I think that is the changing, what's changed the dynamic for me in that scenario is that Bitcoin has been, and other cryptocurrencies have been, the best performers versus inflation. So we can say what we want about the traditional inflation hedges like gold, which I still believe in holding physical, and stocks. But the reality is that Bitcoin is up 300% in the last year when inflation has really taken hold, and gold is flat. So that's kind of changed the dynamic for me a little bit in terms of trying to fit into what's going on with this picture. But I think that there are a lot of things that I see that make it very different this time. And that's important to follow on, in my opinion.
Yeah, something I've noticed since the Fed paper announcement a couple weeks ago is that the market, the things that have been leading higher, crypto, Tesla, a lot of the electric car companies, some of the, excluding biotech, a lot of the more money-losing tech type things, and utilities and staples. It seems like that the market has become more correlated to, as higher it goes, it's become more positively correlated to the Treasury market. And the fact that maybe TLT has been weak has been what's holding down the market lately. Is the risk charity trade over? And is the main driver for markets going here, just from a technical correlation perspective, is real rates continuing to fall?
Man, that's a really hard question for me to answer, as I'm not a bond market specialist, but I'll tell you the mechanism, kind of the way I've been following it, which I think is along the similar line as the way you've been following it. Equities right now are consolidating right at the highs, right? It's just kind of to me, a healthy rotation at the highs, and it's still very much in a bull trend. Related to your question, sort of what in the bond market is sort of driving this, I've been watching break-evens, right? And we're kind of looking at the similar thing in TLT or other inflation-adjusted securities, but break-evens are another market-based inflation gauge that have been consolidating for a long time and just took off again, right? So with their taking off again, it seemed to coincide with me in just sort of across the tape with the stimulus bill being signed, right? There's another breakout. Oh man, another trill going on. The deficit break-evens breaking out, rates breaking back up higher after a dip. like, to me, that's still, the market is still very much sensing inflation and admitting that that's happening, right? So it's like, I don't know, I don't like to make bets on which way real rates are going all the time. I'm more happy to watch, break evens versus, the 2-year, the 10-year, the 30-year, and the curve, and decide what the bond market is accepting about the inflationary scenario, and at least how they're rejecting at first, how it was going along with the transitory narrative, right? At first, when Jerome Powell was saying it's transitory, prices were spiking all over the place, and the 10-year was yielding 1.25. And you're like, how is this even possible, right? And it's just, for whatever reason, the bond market was going along with the transitory narrative. And then as the commodity market started taking off and we signing more infrastructure bills, et cetera, and having more and more energy crises across the board, you look over and now rates are right back up again, right? The 2-year paper, bidless, right? Short-term rates spiking much higher. So those are that's kind of the relationship that I've been looking at to follow the bond market and to follow what it's allowing the equity market to do. It's like the equity market can handle higher yields as long as there's some economic tailwinds underneath the hood and the economy is functioning okay. So, that's sort of the driving scenario for the stock market for me, and sort of how the bond market reacts to it. I'm still in the camp that we're going to slowly see rates grind higher, break evens higher, more bond market acceptance of the inflationary scenario.
So then why are you seeing a rotation into long duration as they're effectively deflation assets right now?
I'm just seeing what the market says, Nick. I see 2-year paper go bidless and spike, and rates spike. I see 30-year paper go bid only, right? And 30-year yields just get mashed below 2%. And you're like, okay, this is a serious steepener going on here. Long ends, rates down in the long end seems to, propel that mortgage business and the refi business. And I think that has to do with why builders are breaking out, and banks have been at least sideways to higher rather than sideways to lower, right? So I guess we kind of look at the market through a couple of different prisms kind of thing, if that's fair to say.
Yeah. And then the next question I have is, we've kind of already kind of got into this with the inflation comments, but what are your thoughts on some of the major commodities here, ag, oil, gold, and copper?
Well, I put it this way, that they're really important, right? I've maintained a bullish posture in oil for over a year now, and I have one concern and one concern only, and that is the historical data whereby when 1-year calendar spreads widen beyond $7 backwardation, spot price actually tends to struggle, right? So what that means is that the curve gets so steep is that everybody is willing to trade front month supply for back end supply, and what it does is it actually causes a real churn in the markets. So since crude oil has been sort of sideways down from the $85 high, now trying to find a low on the dip, we've had that 1-year calendar spread between $9 and $12. So as that backs off a little bit, I can say, okay, if the 1-year spread is going to back off, then I'm going to look for crude oil to resume strength. I think the crude oil market, to me, is very much a bad chess match between the United States president and Saudi Arabia and Russia type of thing. If you follow that narrative, you'll see that the president, cut off the pipelines from Canada. He, went ahead and discouraged investment in various different ways without going into discussion, and then he asked OPEC to pump more, right? So kind of a transparently, visibly naked, irresponsible move. And then you saw if you saw what Saudi Arabia's response was, Prince Abdulaziz was like, are you crazy? Like, we face another COVID lockdown or something. We can't open up the taps now and, just let the market tumble. So to me, they're playing off of each other, and it seems like this can be a match that, unfortunately, MBS in Saudi Arabia might be able to win, because I think that they want oil in the hundreds, and I think that the conditions are set to get it there. So that's my spiel in crude oil, and I'm kind of saying that it's different this time, where it's saying that I'm remaining bullish because of the ESG situation and because of the push to carbon neutral. That's very different this time, right? We never had a government that was really putting the clamps on supply, when normally that has been the answer to high prices. So that's what I fear about oil, is that it can get into the hundreds, and we can see $6, $7 gas in New York, which is outrageous. So that's my oil view. I think that feeds perfectly into my ag view. I got my clients long DBA, which is an ag ETF, Nick, today, and this week especially. It's been breaking out of a 9-month consolidation with the grain rally, the recent grain rally. If a third of grain prices are energy costs, and all energy costs have to do is remain elevated for grains to continue to price higher and higher energy costs, I'm extremely bullish grains. I'm nervous about there being a food crisis in this country in the next couple of years, just because of what's going on. It's getting really competitive globally, and, we're going to be left up to our own production, I think, in a lot of ways. And while I think that's fine, I think that the spiraling costs higher is going to be a big problem. So I'm concerned about that. I'm bullish that DBA in the ag sector. I'm bullish ag. And the other commodity you mentioned was copper, and I have to admit that copper has had me in stitches for 6 months. It formed a head and shoulders pattern. Technically, it looked like it was going to break down. It wound up bouncing off the 200-day moving average 4 times. It just broke out to 10K and failed miserably and pulled right back to where it came from, which is the middle of the range. It's back to middle of the range. It looks like it wants to trade sideways to higher. It seems like if we're going into this ESG predicament and putting this on the tape, and we're going into it needing a lot of copper, and with the copper inventories as low as they are and the curve as backwardated as it is, it seems to me that the scenario is set for prices to rise in copper also. So I'm still betting on that, but I'm getting less and less confident that I'm right, because copper just can't seem to catch fire. So that's my view across the gold, ag, and copper space, if that's fair.
Yeah. And then from a momentum perspective, what would you be looking for that would change your bullish outlook?
Oh, man. That's a great question, Nick. I think a break from the pattern that the S&P has been illustrating since we came off the lockdown lows, if that pattern changes or breaks, and I'll describe the pattern in a minute, then I would be really, really concerned. And what seems to be happening with the pattern is, we're in a bull market run in stocks. Stocks get way above their moving averages, and pundits on TV will point to a headline and say that's why stocks are selling off, and I don't ever believe that. I believe that it's just because there's too much complacency. There's too much sentiment redlined in the bullish category, and all of a sudden one sale leads into the next sale and things back off. But what the S&P has been doing, it is, as vol spikes, there have been 2 or 3 really steep red days, and then at the end of that, there's been a red to green recovery day. And if those steep red days down have huge red extreme tick indexes, where, bigger than, say, negative 1,500, and that's a Bloomberg reading. The tick index, it measures how much of the New York Stock Exchange is trading on the bid versus the offer, and usually means a big negative print means that all the bids are trading at once. So if we see extreme tick prints in that 2-day sell-off and then a red to green day, that's usually the start of the recovery. It usually bounces off of a moving average or something, and then next thing you know, we're off to new highs. I mean, I can probably count on my hands 10 times that's happened in the last 8 or 10 months. And so when that pattern breaks and we start to have 5 or 6 steep red days, and we start to break moving averages without pausing at them and trading back and forth between them, and finally, if we start to spend some consecutive closes below, the S&P's 200-day moving average, which, let's take a look at it and just see where it is, because that's really the only thing that's going to get me to turn. Right now, it's back around 4,200. So for me, there's a lot of room for the markets to pull back, remain in an uptrend. But like I said, a pullback that steep will certainly change that pattern of just having 2 or 3 big sell-offs in reaction to some kind of a news headline and then a recovery. So, I kind of welcome sell-offs lately, Nick, and I'm going to continue to do that until I get burned, just because this pattern's been playing out. Once the S&P trades into moving averages, consolidates, and gets back up above it, it has been a great buy for the last 3 or 4 times it's done that, 5 times. The Evergrande pullback that we saw in September, October, was a real test and a really fun test to navigate through the markets. It looked like it was going to go, and by go I mean break down. But we just kept an eye on the high yield markets, and the high yield markets never came apart. The commodity markets never came apart, and next thing you know, risk gets back on its feet again. So I'm playing the markets from the bull perspective. I'm looking at, I'm greeting dips with open arms. I'm trying to be careful about what I buy. I understand that there are a lot of sectors, especially oil right now, where the rally is getting long in the tooth and probably into the later innings, while other sectors like cybersecurity, software, home builders, maybe banks, maybe a few other tech sectors, those look like they're in early stages of a breakout. So that's kind of how I've been shifting assets a little bit, if that's fair.
Yeah, that's a great way to look at it in terms of trying to figure out how to manage risk and when to change the trend. The next question we have is, what are your thoughts on the resilience of vol? Because usually when you have such a complacent market that we do right now, you would have VIX below 15 and stay down that low, and you wouldn't have as many days where the biggest names like Apples and Teslas in the world are moving 2, 3, 4% every day.
Yeah.
It's kind of unusual. I wasn't really trading in the late 90s, so I don't have that kind of perspective.
Mm-hmm.
But what are your thoughts on why vol has remained elevated despite otherwise calm and bullish market?
Yeah, I think I saw, if it's fair, like I noticed that the low in vol used to be literally like around 10, right? It used to be like 8 bid of 12 was the low of the range, right? And then I kind of perceived that the 2016 election, when Trump was elected, vol, they priced in an extra 20% of volatility for President Trump being in office, right? And then the lows in vol became like, 11 bid at 15 was really the bottom. And that's kind of where we are now, right? Like even as the market rips through the highs, the VIX, as you say, is still 12 bid, and you're like, wow, how is this maintaining that? And I think it's just pricing in that extra level of risk. And I'm not a vol expert, and I know that may sound pedestrian, but I think that the market realized that 8 bid of 10 in volatility was not realistic heading into this world where we are now, where, like you said, you see individual names completely explode in volatility. I kind of think that that's why, the VIX prices in a little bit higher premium. And I'm sorry if that's not a great answer. You know what I mean? But it does seem, it's not something I trade off of. It's just kind of a speedometer, that I view and mind. And, the kind of thing where with VIX in the 20s, I'm making purchases. Like that's my mantra. That's my mandate. It's like you have to be set up so that when you get the spikes in VIX, in vol, and those steep 2-day sell-offs, you can make some purchases. Right, and if you don't sell some stocks at the highs and rotate into some other sectors, you can never do that. So that's been the most challenging part of staying with this rally for me, if that's fair to say. And the VIX is just a very small part of the speedometer that I'm watching.
Yeah, and the last thing before we go to Q&A is what are some other noteworthy, interesting things you're seeing in the markets that we haven't previously talked about?
Let's see. I'm trying to think of what's interesting. The aluminum market is really important to watch right now, even though, copper is, Dr. Copper and a great referendum on the economy. I think that aluminum is important to watch because it plays into, China trying to sort of conserve energy in certain provinces and put clampdowns on industrial production and things like that. As they are a big driver of the base metals markets, I've got a really close eye on aluminum now. Aluminum was a big-time leader of the base metal rally. It just had a steep pullback from 3,200 to 2,500, where the 200-day moving average is. So for me, this thing, aluminum and the sort of whole base metal market is on the brink right now. And I feel like aluminum is going to hold. Like I think that there are buyers on this dip, and I believe that if I had to buy aluminum, that I would be buying the crap out of this dip between you and I. But it seems to me that if aluminum can get back on the run again, that's going to become another self-fulfilling, here go base metals again. and then you'll see copper get off its ass and nickel start to run. And forget it, the other, lithium and cobalt, two of the key elements to, battery infrastructure. Those are really dear. Those are really hard to mine. Those are getting really expensive, and that is also a part of the EV trade that's going to help drive base metals higher, I think. I think that when people realize they can't get enough lithium, they can't get enough this and that they're going to wind up saying, okay, we need a strategic investment in base metals across the board because this stuff is getting hard to get your hands on.
All right. Well, that's something I definitely am going to check out, especially because of how correlated it is to Asian markets.
Exactly. That's the one reason it's really important.
Interesting setups here, given the conditions of the global economy. So,
totally.
Thank you for joining us, Tony. If anybody who's viewing this wants to get in touch with you, what's the best way they can reach out?
You can email me at tony@tgmacro.com. That is my website, is tgmacro.com. There's some information about my publications there. I'm the editor of the Morning Navigator newsletter, and I have a couple other products that might be interesting, and I'm on Twitter at tgmacro.
All right, thank you for joining us. Now we're going to go to Q&A.